Hello, everyone. Welcome to the live stream. Today, we are live streaming Amazon's quarterly results Q2. I'm so excited to be live streaming with you Amazon's Q2 results, and we are half an hour away from the closing bell, and Amazon is about to announce their Q2 results without Jeff Bezos at the helm. For the first time ever, we have a quarterly result earnings call that Jeff Bezos is not the CEO of Amazon. After so many years, we have a quarterly result that is going to be completely led by an Amazon team that is running the company without Jeff Bezos as an active um, member of the management. So if you've seen Jeff going up to space, it was really a high quality event, and just kind of you can see the power that Amazon gave him in terms of making his dreams come true and creating a lot of I would say a lot of really great PR for Amazon and him. That Blue Origin flight. Now, before we start to talk about this quarter, let's talk about the quarter we had before. And just want to talk about those monstrous numbers that Amazon had. I'm going to put them on the screen. You can see that Amazon had an operating cash flow that increased 69% to 67 billion for the trailing 12 months. And you just can see that they had a really great quarter last quarter. And I just want to put all the numbers so you can see here. Really great quarter last quarter. Um, let's see. In terms of revenue, I want to show you the revenue numbers just because they were so out of this world. The revenue numbers were really mind blowing. I think it was 100 billion. Let's um, let's download the report really quickly. Open it up. See those revenue numbers from the first quarter of 2021. And okay, so I'm just gonna zoom in here so we can see. So the operating income out of the net sales. Yes, it was net sales of 108.5 billion in the first quarter. That was just kind of a bonkers number. Imagine generating 108.5 billion dollars just in sales. There are companies in the S&P 500. There are companies in the S&P 500 that do not reach that market cap. That is how much that's bonkers. So, in terms of like the percentage increase, 44%, that is the number you'd expect from a growth company in much more initial stages of the business, not like a level of matureness that Amazon has. So, um, what else do we have here? Operating income increased to 8.9 billion compared to operating income of 4. So for those of you who don't know how Amazon operates, Amazon does not like to earn money. Amazon likes to lose money or to not make any money. And the reason they do that is because they don't want to pay much in taxes. They want to reinvest everything in the company. They want to invest in growth. So when they finish with very small amounts of operating income, they can actually do that. Um, so this is from Jeff. Two of our kids are now 10 and 15 years old, and after years of being nurtured, they're growing up fast and coming into their own, said Jeff Bezos, Amazon founder and CEO. As Prime Video turns 10, over 175 million Prime members. So let's stop right there. So Amazon is talking about how they reached 175 million Prime members that streamed shows and movies in the past year. Meaning that Amazon Prime is much more than just, oh, I want to get a delivery fast to my door and I want to get all kinds of discounts. Amazon Prime is now, I think, a legitimate competitor in the world of streaming. Now, we know Amazon has been investing a very in kind of like a very methodological way, kind of in creating shows that want to win awards. They're creating movies that they want to win awards. They're bringing a lot of money to the table to create a show that is based on the kind of a prequel for Lord of the Rings. So this is supposed to be the most expensive TV show ever produced, and this is all happening on Amazon. If you have experience with Amazon Prime, you know that for years they've been fighting to bring that 2 day delivery and then the 1 day delivery. Just today, I saw as an Amazon Prime user when I bought something that I could get an overnight delivery, which was very interesting to see that even though there is so much of demand for overnight deliveries, they're still able to do one. And I ordered it pretty in the middle of the day. So um, let's see what else do we have here from that first quarter. Amazon ranked number one U.S. LinkedIn top companies in an annual list. So Amazon is saying that they're ranked according to LinkedIn as the one of the best places to work with. Um, I don't know that, but I think that if you were talking about which companies right now hiring the most in the United States, probably Amazon by a large margin. I think that they have over 1 million jobs opening before the end of next year. Let's see what they have here. Amazon expanding its workplace health and safety programs, aim cutting recordable incident rates by 50% by 2025. So last quarter they were talking about incidents, probably incidents in their warehouses, that they want to cut the amount of incidents by 50%. Amazon is fitting delivery vehicles with camera safety technology. Um, so interesting. So Amazon put technology in the vans of their drivers to help them avoid all kind of risky situations and decrease the amounts of crashes and stop sign violations. And basically, Amazon is really investing a lot in the overall well-being of their employees and making sure that they're trying to stay safe as much as possible using technology. Now, if you are just joining us, we're going over the first quarterly results before we see the second quarter results, and just kind of recap where we left off. In India, Amazon announced that they're adding 300,000 jobs. So this was in April. So 300,000 jobs in India. Now we know the situation in India due to the new COVID strain is not well, and 300,000 jobs probably for people there is something that is well received by the Indian government, and I'm pretty sure that Amazon is making a lot of friends in the Indian government by creating so many jobs in that country. Now, for those of you who don't know, the population of India is around 1 billion people, if not a billion point two. And I think that 300,000 jobs is just kind of like, a cornerstone in what Amazon can do in India. Let's see what else do we have here. Since January, Amazon has opened in the Seattle campus. Nearly 50,000 have been administrated. Okay, so Amazon just talking here how last quarter they used their facilities to help administrate vaccines. What else do we have here? New signatories to the climate pledge. So just to jump back to the numbers, I'm expecting to see Amazon jump over that hurdle of $110 billion. They were talking about looking forward into the year that they're not going to grow um, by the same amount they growed from quarter to quarter. And I'll be as honest as possible. I think that they're being conservative. And the reason I think they're being conservative is that it's the first quarter without Jeff Bezos as the CEO, and to if I remember correctly, he's not going to be on the call. Everything is going to be led by kind of the new CEO, and I think that they're gonna beat earnings. I really feel that there is too many things going well for Amazon. There's too many things going well for the store, and even though there's a lot of competition, don't get me wrong, There's competition with Target. There is competition with Walmart. And there is competition with Costco. Even though that competition exists, I really feel that this quarter is going to go well for them. So I'm going to put here CNBC in the background and see if there's anything coming up. We are 20 minutes away from the closing bell. So for those of you who don't know, Amazon usually likes to announce around 15 to 30 minutes after the bell, and then you have to wait around 2 hours, or I'm sorry, you have to wait around. I think, I think you have to wait around a full hour. Yeah, full hour at least before the earning call starts. So just take that into account if you are looking to stay here for the earnings call. So I'm really excited to see what they're going to have in store for us, because I really think that there is a lot to talk about also in terms of Amazon Prime. I think their entertainment division can continue to bring all kinds of news. I think that they are. I think they're really in a great position to start talking about things they've never done before. So, if you've watched one of the last live streams I did, I'm not sure that I talked about this, but if I didn't, then I'm talking about this now. Amazon can build houses. Right now, there's a housing shortage, and I really think that one of the next steps that Amazon can do, in order to really hit a next level of revenue, is to build houses. There is a housing shortage, and in order to create houses, I understand that it's a different set of logistics, but could be that Amazon is probably the perfect candidate to create houses. And if I had to bet on which company would solve the housing crisis without it being a one of the builder companies, I really think it's going to be Amazon. And I think they're in an excellent position to just drop houses off trucks and just basically leave kind of everybody in the dust in terms of competition of selling houses. They can just buy land, probably buy much more land than hedge funds that are right now buying land, and just really, um, really hit it home. So that's kind of my 2 cents on what I think is in store here for this earnings call. And I really hope that I'm right. I really hope that Amazon starts talking about actually um, selling kind of out of the box houses. And if they don't, then we'll have to wait a couple more quarters. I really hope they do, just because it would be really exciting. And I think nobody on Wall Street is going to see that coming. So let's see what we have here in terms of the news. What is going on in the news? Let's see here. So just putting in Amazon's ticker symbol. So Amazon stock is right now trading $3,591, 1% lower. We're talking about a stock that made a very nice run up. So I'm just gonna open here really quick. So the news that we can kind of go over. So I'm gonna detach this, and we're gonna put this in the middle of the screen. Yes. Okay. So it's gonna be a bit of hard for you to see, but I'm gonna read for you um, what is going on. So let's see how these investors are paying. NSA chief avoids comment on Bezos slander pitch. Understanding Amazon. Okay, so there was unusual option activity today with Amazon. Just opening it up, and the sentiment is bullish. So there is bullish sentiment in terms of option activity. And curiosity, it's around the strike price of 3,800. So the stock right now is trading, like I said, around 3,593, $3,593, and there is a bullish sentiment. Options play around the $38, and if I go to the date of expiry, we're talking about um, July 30th, which is right around the corner. Somebody's really building on a pop. So a lot of volume on that play. Might be a hedge. Maybe somebody shorting Amazon. So that would be interesting. Let's see what else do we have here. FDA on July 26th issued a letter to Amazon on distribution of sexual enhancement weight loss products in violation of Federal Food Drugs Cosmetics Act. Okay, so that is interesting. Um, let's see what else do we have here. Today's market minute, sustainably beauty store that needs financial fine tuning, top trending. Okay, so top 20 trending stocks on Wall Street bets. So apparently, you have here Amazon trading on trending on Wall Street bets. Now, if you've just joined the live stream or you've been here for a while, this is the time to press that like button just because it is free and it shows the channel love and it helps me a lot. We are 15 minutes away from that closing bell. And if you're new to the channel and you like news about stocks, stock research, just trades ideas, crypto, angel investing, welcome to the channel. This is the time to subscribe to the channel. And like I said, hit that like button. So just going to reset here, CNBC. I'm going to make sure that I didn't miss anything interesting in the Q1 report. I have um, just most of the important information. Um, Company has a lot of cash on hand. They can do it at maybe acquisitions. Um, there's no news in the investor relations area, but I know that they're thinking about doing things with Alexa. So should be interesting to see what they have in store. And maybe there's gonna be some innovation from the Alexa standpoint. Um, what else can we expect from Amazon earnings? Will Amazon go into the car industry? So we know Apple wants to build a car, and we know Amazon is invested in trucks. Will Amazon build its own car? So that would be a very interesting thing to kind of follow and see if that happens eventually. So that is something I am looking forward to see if that happens. What else do we have? What else can we look forward? Price action on Amazon is getting a bit better, by the way. So we are 13 minutes away from the closing bell. And we have Amazon stock currently trading around 0.9% under. So that's good news. And I'm just going to pop here CNBC again. And you know what? Just kind of until the um, earnings call starts, I want to know in the chat, do you think that Amazon is going to beat earnings, or are you in the camp of people who thinks that Amazon is going to disappoint on earnings? Let me know what you think. Do you think Amazon is going to beat earnings? And if they are, by what margin? I'm really interested in knowing what you guys think. Is Amazon going to beat earnings by a high margin? And maybe the uh, it doesn't matter. Maybe there's so much expectation that even if they beat the stock will be sold off just because of the run up it had until now. So that would be something that I would take into account. Just kind of remember that it sometimes doesn't matter if you beat earnings or not. It can maybe be just that everybody kind of expected that the price right now should be the price. Sometimes the market just gets it right. So that's just another something to take into consideration. So I have a bit of lag today with the CNBC TV, just kind of jumping, and you can and we see here on the screen the countdown for the Amazon earnings. So I guess people on CNBC are also looking forward to see this earnings result. I'm really hoping that we're gonna get something out of left field that nobody's expecting. I don't know what yet. There are so many options. we can talk about here of things that can come out of left field. Um, I already have my prediction. Maybe houses. Maybe Amazon will talk about Amazon Pay more. Maybe they're going to talk about Amazon moving more into the realm of fintech. Um, One of the things that I know for sure they're going to talk about, Amazon is going to talk about pharmaceuticals. So in Amazon's earnings call, they're going to talk about how they're going to deliver pharmaceuticals to people's home and how you're going to be able to basically get any kind of prescription from your doctor, and Amazon can be shipping that prescription drug right away to your house before you even leave the doctor's office. That is kind of a um, place where I see Amazon taking their business. And when you think about it, it just makes perfect sense to go down that route because it's easy for Amazon to ship overnight things, and if it's easy for them to ship overnight things, it's probably also easier for them to ship in the same day. And who doesn't want to have their prescription drugs shipped on time? There are some people who really need their prescription drugs shipped on time, and those are the kind of people who I think are going to use a special service, a special Amazon service that is going to ship for you drugs in a kind of a just-in-time manner. So, just off the top of my head, what I think is going to be a very interesting line of business that Amazon is going to probably expand on. And I think it's really going to be easy for them to give uh, like, a great experience for people who want prescription drugs shipped to them. And I think it's going to be very challenging for CVS and other, I would say, pharmacy companies to fight this because they don't have that logistics arm to get to people. If you need to pick up your prescription drugs from a CVS, you have to get there physically. There are big box stores that are starting to put in pharmacies inside the big box stores. I know Walmart have been trying to do this, and this might, probably try to give Amazon like a fight in that realm, but there's a good chance Amazon will be dominating a whole market of getting drugs to your doorstep. So that's regarding that. By the way, just in the last few minutes, price action was not great, there's no way to say it lightly. The stock is not trading in the most, I would say, bullish sentiment before this earnings call. We are 7 minutes away from the closing bell, and I am pretty sure that there is going to be a very interesting call with the analyst. Just because I'm reminding you, this is the first earnings call that you do not have Jeff Bezos as the CEO of Amazon. Um, so before we even reach that earnings call, I see here on the news Robinhood thinks on market debut, and Robinhood is right now trading under 7.6%. And for those of you who do not know what Robinhood is a trading app which gained a lot of popularity for being kind of the trading app that most first time traders decide to use. So that is kind of what is happening right now in terms of like what is trending in the news. And you can see the S&P is up today, and it is not thanks to Amazon. It's because you have a lot of companies trading up today. Let's see, just off the top of my list here of holdings that I have, you have Apple, you have American Express, Bank of America, Citibank, you have Salesforce, you have Chipotle, and you have um, Microsoft trading just a bit up today. A lot of names trading up, so there is a reason why the S&P is up today. But Amazon before earnings is trading down. So if you've just joined, I want to hear you in the comment section in the chat. Write me in the chat, what do you think? Do you think Amazon is going to beat earnings? Do you have a stake in Amazon? Do you own Amazon shares? Let me know in the comments what is your position right now. I really want to know. And we have now Stephanie Link from CNBC on the screen. Let's see what she has to say. Um, Nothing really related to Amazon. They keep talking about Robinhood apparently. So if Amazon wants, they can literally buy any company that is bothering them in terms of competition in any realm. And I think that one of the companies that Amazon should buy is a fintech company, just because they already have Amazon Pay. And oh, okay, wait. We have a comment finally. Michael Forden, huge beat as always. No stock split as always. Stock flat as always. You know what? I'm gonna take the other side of that, Michael. Okay, so I hope I'm pronouncing your name right. So I actually think that there is going to be a stock split, and the reason I think that's actually gonna happen is because Jeff Bezos is not the CEO anymore. So I think we're gonna have 5-1 split. Why not? Nvidia did it. Apple did it. Why not? Why not have the stock split? If Amazon decides to trade with a $500, $700 stock, does that give them any less prestige on the price point? So if you think that Amazon is going to split their stock, if you are taking my side of the bet, hit like. If you are taking Michael's side of that bet, which I kind of dragged Michael into a bet without him even kind of accepting to the bet. But if you take Michael's side, then don't hit the like button. Share this live stream with a friend so they can join us for the quarterly results. We are a few minutes away from that closing bell. I'm going to refresh once again the CNBC live stream just because it's a bit lagging. I'm going to be refreshing it again once more before the closing bell starts. And I am super excited from the prospect now of a stock split. I didn't think about it that Nvidia were the last company to do that with a very high stock price. Not like really, really high. It wasn't in the thousands, but it was definitely in the high hundreds. And Apple's stock split was not too long ago. Um, Tesla stock split was in the past, I think, half a year, 9 months. So maybe it's Amazon's time to do that. I don't think Amazon wants to have $5,000 shares. Um, how is that helping them reach new shareholders? How is that helping them reach um, new users? Because I really think that there is a correlation between people who hold a stock and use the product. So for those of you who know me and it's not your first time here, you know I hold a lot of Facebook shares because my job is related around Facebook, and I do hold a lot of Amazon shares because I do have also things that are related to my work on Amazon. But it's going to be very hard for people around the world who want to participate in investing in Amazon if they don't have a brokerage account that allows them to trade in fractional shares. So I actually have a very good friend who is probably not on this live stream because he's working right now. But quick story, he wants to buy Amazon shares, but he can't. He does not have the money. Fractional shares are not an option because he does not live in the United States. And when you don't live in the United States and you want to buy Amazon shares, you better have $3,500 on hand in order to buy Amazon shares. So you can agree with me that whether it happens or it doesn't happen, that Amazon needs to split the stock if they want to get more international kind of investors. So if you agree with me, by the way, that the new CEO that has just taken the job from Jeff a few weeks ago, if you agree with me that there needs to be a stock split, this is the time to hit that like button to show me how many of you on the live stream think that Amazon should split their stock. And you can tell me in the chat what kind of split ratio. But if you think that Amazon needs to split their stock in order to add new investors from more international places, people that have brokerage accounts without fractional shares, hit that like button. And if you are new here, it is the time to subscribe so we can meet again in other live streams, other earnings calls. And I also did a review not too long ago about Amazon stock, and I explained why I'm bullish. And right before the closing bell, I'm going to tell you a fun fact. Amazon is the third largest advertising company you've never heard of, and I'll explain to you why. Amazon does not break down their advertising revenue, but they have two forms of revenue. One of them from advertising. They have two forms of revenue in advertising. One of them is advertising on the Amazon.com site, which is kind of the sponsored ads you see. And the second form of revenue that Amazon has on their site is the revenue that they generate not from the Amazon.com site. They generate from something called A9, which is a publication digital supply platform. So Amazon actually helps publishers, newspapers, online magazines to monetize their inventory, and they have display ads and video ads, and they do a really great job. And they're probably the fastest growing advertising player right now in the market. So I have the newsfeed open, and let's see what Amazon has in store for us. Does Amazon have in store for us a surprise? I am refreshing the feed, which in a very timely manner decided to freeze on us. Thank you, CNBC, for having a wobbly feed today. And let's see what Amazon has in store. Is Amazon going to surprise to the upside? Beat, not beat? Let's see. What are we going to get? So, just photos of Riskified that went public today. Kudos to them. Riskified, Israeli company, which I'm pretty sure has some form of business with e-commerce and probably with Amazon. Maybe yes, maybe not. I'm not sure. So Dow finished up 0.44%, S&P 500 up 0.42%, Nasdaq up 0.1%, and the Russell with a gain. So S&P 500 finishes just below record close level. We are waiting for Amazon's results. If you just joined the live stream and you are excited for Amazon's results that are out, hit that like button. We have the results. So Amazon sales right now for the second quarter have reached a whopping number of, drumroll please, are you ready for this? $113 billion. Ladies and gentlemen, $113 billion in sales. Amazon's net was $7.8 billion. The earnings per share was $15.12. So, has Amazon beaten their earnings per share estimate? Before we talk about that, they have given guidance forward for Q3 sales anywhere between $106 and $112 billion. Amazon sees operating profit between $2.5 and $6 billion for the third quarter. Amazon breaking their kind of revenue. Product sales was $58 billion. International segment sales were $30.72 billion. North America segment sales were $67.55 billion. And Amazon services sales were $55 billion. So you have here a huge combination between Amazon services and product sales. So Amazon beats on these quarterly results, and we're right now, from what we're kind of seeing, the stock is selling off, ladies and gentlemen. We have the stock selling off. I'm going to be refreshing here the CNBC feed once again just because it is so slow. But I can tell you right now, Amazon is trading $150 lower, $160, $170 lower that it has been trading before the closing bell. So Amazon's stock is trading way lower than I expected on such a beat. Now, when we're looking at percentages, the beat was 15.12 above 12.22, which means that the beat was around 15% 18% beat. That's the kind of beat that Facebook had kind of the range. So when you have that kind of range on the beat, I think that you can expect the stock to trade tomorrow, just like Facebook was trading today. I really think that you can expect to see tomorrow down day for Amazon. It will be probably anywhere between 1 and 5%. The stock had a great run up. I think that there are a lot of investors that keep, I would say, being disappointed by Amazon not leaving cash in the company and just investing so much in growth and not leaving a lot of operational revenue inside the company. But from what I kind of remember, Amazon is really, really kind of, I would say, fanatic, really invested in killing it in the streaming business. So a lot of money is going to Amazon Prime video service, which I was talking about this before. And Amazon is investing a lot in shows and movies that they want to, win awards. And one of those shows, one of those movies that, one of those big blockbuster TV shows that Amazon is investing in is the prequels for Lord of the Rings. Now, if you are a Lord of a Rings fan, this is the time to hit that like button if you are excited for Amazon's show that's going to be about Lord of the Rings. And if you are shocked by Amazon's, I would say, trading action, the price action after earnings, this is also the time to hit that like button. Amazon is selling off, and it's really fighting to keep that $3,400 level. They beat earnings, and they did not miss in terms of earnings per share, but still not the best result from Amazon, which kind of came in line with, I guess, expectations. So the expectations of Amazon were, before the quarter, they were saying a number that was just under the 113 billion that they reached. And I was bullish in the beginning of the stream that they were going to hit that number just above the $110 million. And they did that. So kudos to them. I am excited to wait for the... I'm excited to wait for the call, just because Jeff Bezos is not going to be on the call. We're going to hear a new CEO. We're going to see how he sees things. Maybe for the first earnings call, he's going to keep a lot of things really, I would say, in line with what Jeff wanted. So I'm just going to put here the volume so we can start listening into CNBC. I ranted for more than half an hour since the stream started about what I think was going to happen. And right now we have the results, and we're just waiting for that earnings call. Nothing really out of the ordinary, by the way, inside the messages. I see that free cash flow decreased to 12.1 billion for the trailing 12 months. So probably investors were not happy about that. Operating margin, 6.8%. Not the best operating margin for a company of this size. And Amazon plans to open AWS infrastructure regions in the United Arab Emirates in the first half of 2022 and in Israel in the first half of 2023. So Amazon expanding on AWS. If you are a fan of AWS and their services, that's another reason to hit that like button. So I'm going to leave us with Stephanie Link. I'm going to unmute her, and I am going to get a glass of water while we wait for the earnings call.
No, is it Prime Day that wasn't as
And
strong?
some technical
Is it,
difficulties. Here we go.
tougher comparisons? They get even tougher though in the back half of the year. So we got to get some explanations on the revenue line, and I haven't seen the spend number either, and I want to see that as well.
see Amazon now down trading 5% lower from today's close. Meanwhile, Gilead's earnings are out. Meg Terrell has those numbers. Hey, Meg.
Hey, Mike, Gilead beating in the second quarter on both earnings and revenue. Adjusted EPS $1.87 versus $1.73. Consensus estimate revenue was $6.22 billion versus $6.07 billion that analysts were looking for. Across the franchises, HIV, its biggest, might have come in just a little bit light. $3.9 billion, down 2% year over year. HCV, hepatitis C, actually was better than expected at $549 million, a bit beat coming in remdesivir sales, $829 million in the quarter. That compares with an estimate of $655 million. It's a company also essentially raising slightly but narrowing the forecast for the full year. But you are seeing an increase in it.
Watching this share. Across the board, but double digits. So I think, look, again, with Amazon, you can't miss revenue when your stock trades at the valuation that it does, and your stock also rallied 12% into it. But very tough comparisons, as Deirdre highlighted, against a year ago. And so that was the concern going into this year. Can they continue the momentum? And they are continuing the momentum. This is still very strong growth, but against a very high against a very high bar.
Yeah. It gets you back to about mid-June levels of the stock so far after hours. Steph, thanks very much. Talk to you soon. Stephanie.
Thank you.
All right, still ahead, much more on Amazon's results and whether you should buy the stock on this dip when we're joined by a bullish analyst. Plus, T-Mobile just releasing its results, and CEO Mike Sievert will break down the numbers when Closing Bell returns in 2 minutes.
Amazon and Pinterest both just out with earnings, both stocks dropping after hours, especially Pinterest. With Amazon, it was a top-line miss, disappointing guidance. Pinterest, it was the user number, which was a big miss. That stock down more than 14%. Also, just out, T-Mobile beating on the top and bottom lines, raising its full-year guidance. T-Mobile CEO Mike Sievert joins us now for a first on CNBC interview. The stock is up after hours. Mike, good to have you here on earnings day.
Thanks. Hi, Sarah.
Hi, so I'm looking at these postpaid numbers, ads, 1.28 million. That was better than expected. Raises your postpaid net ad guidance. You know, Verizon also being raised. Well, where are these new subscribers coming from? I thought this was a saturated market.
Well, in our case, it's coming from overall new accounts. Our new account growth was the highest in our company history. 349,000 new billing relationships just this quarter. And of course, that's coming from taking share from AT&T and Verizon, from big cable and other places. But it's just an exciting development for us to be able to come out at halftime on the year and beat expectations on the top line and the bottom line.
So what kind of outlook are you giving, given the fact that we have seen such a strong period of demand for people signing up for wireless during COVID and with stimulus checks in the pockets and for whatever other reasons?
We do see an opening up happening all across the country. We'll have to see what happens, with the Delta variant, et cetera. But people are back in our stores, and our stores are operating safely across the country. And we're seeing switching return to the market. And in the second half, that's always been traditionally when the action is. That's when Apple sometimes brings new devices out. It's a back-to-school season. So we funded our plan to be competitive on the year, and yet still raised our guidance across the board, including for cash flow and EBITDA and revenues for 2021. And that's based on the strength of 2 strong quarters, but also what we're seeing for the second half.
What does it mean, more specifically, to be kind of funded behind a plan when the action really starts in the second half of the year when it comes to pricing and competitiveness and whether, in fact, things are going to get a little more aggressive on that front?
It's a competitive market, but it's been a competitive market. Every quarter, the nature of that competition changes a little bit, and usually it's us setting the pace. Right now, it's device offers. But all the companies are out there with fantastic device offers, and they're centering them around more and more premium plan offerings. And so the nature of the competition every quarter changes, but the extent of it doesn't really. This has always been an intensely competitive market, at least since we became the Un-carrier, and it is today. And overall, our job is to lead this market in growth, and that's what we did this quarter with the best quarter-over-quarter and year-over-year service revenues, as well as overall account growth.
So you mentioned the upcoming iPhone release. What are your expectations, Mike? You guys get a lot of credit for winning the surveys on best 5G service. How do you translate that into capturing those customers when these new phones are released?
Well, we have to get credit for it. You're right, Sarah. We have the best 5G network in the country, bar none. Everybody who watches this industry closely understands that. But we have to get credit for it with consumers. What we're finding now is that 7 out of 10 consumers value 5G. It's important to them in their decision process. And we're seeing rapid increases in who they're giving credit for as the best 5G network, with us rising 25% just since March in our network reputation, while Verizon's flat. So we've bested AT&T on network reputation, and we have our sights set on Verizon, because the reality is we're way ahead in the 5G race. It's just time for us to make sure America knows it.
What about in the prepaid area? Is that something, I mean, there's reports that you're making an additional push toward those customers, some of whom you shed as part of the deal, the merger between Sprint and T-Mobile. What does that mean for, you know, just exactly how tough it's gotten to maybe down the road to grow postpaid?
Yeah, this is an exciting and not talked about enough part of our plan, Mike. You know, 76,000 prepaid ads on top of already being the biggest prepaid provider in the country. And that's despite being the biggest. It's hard to keep growing when you're the biggest, but also despite big transference happening across the industry from prepaid to postpaid, driven by this economy. And yet here we are, profitably delivering prepaid growth on the strength of the best churn numbers in prepaid we've ever delivered. So that's exciting. Of course, we're out celebrating the movement of 5G on prepaid as well. You know, 5G is not just for rich people with postpaid. It's for everybody. And T-Mobile's leading the way with our new offers from Metro.
Mike, how big of a threat are the cable operators? We've asked you this before, but Comcast, our parent company, out today, they're taking a good chunk of growth in the wireless business. They lowered the family plans to be competitive and are showing profitable growth here as well.
You know, it's been consistent over time, Sarah. I'll back up a few years and say we didn't really fully appreciate what they would do in this industry. They came in out of nowhere and established about a consistent 10% share of activations years ago. And it's been consistent ever since. Comcast's best ever quarter that they released today was just marginally up from last quarter. It's just a consistent performance that we've seen, and it really hasn't affected us. As you've seen through those years, we've posted the biggest growth in our history, including this quarter, the highest new account growth in our company history on the postpaid side.
Mike Sievert, thank you very much. We'll let you get to the conference call. We appreciate you joining us fresh off those
Great
numbers.
to see you. Cheers.
CEO of T-Mobile, which is higher after hours, a beat and a raise. Some M&A news after hours to tell you about. Software company Qualtrics is buying Clarabridge for more than $1 billion, all in stock. Clarabridge is a company that offers a platform that allows companies to analyze customer feedback in real time. How people are talking about a brand on social media, for instance, over email and product reviews. Remember, Qualtrics went public a little bit earlier this year. It was a spin-off from SAP, the European company. The stock's a little bit lower after hours. Part of the plan here was to do M&A, and I did have a chance to talk with Zig Serafin about this deal because this is their first biggie, more than $1 billion deal, and he describes it as a way. So basically, Qualtrics helps customers like an Urban Outfitters or a UPS get to know their customers better, and also their employees. There's a big HR as well, analytics, AI, that sort of information. This is complementary, he said, because it just allows them to scan all sorts of chats and social media, everything you ever want to know. People were saying your customers
Listening
tools,
yeah.
Just to give more analytics and to beef up those packages for their customers. He said this is a company that has been growing tremendously, more than 100% usage growth each year for the last 4 years. Clarabridge, the company they are buying, 150 natural language models, which just kind of talks about the scope. It's a big business, 400 enterprise customers. So, $1 billion
Qualtrics
deal.
about a $20 billion company, so
Which
it's
has worked really well. It's had a good quarter.
Since the spin,
CEO's
yeah.
been on with Jim Cramer, Mad Money, talking about the growth, more than 40% revenue growth. They're going to hit $1 billion in sales this year. One to watch. Up next on Closing Bell, much more reaction to Amazon's earnings and what analysts want to hear during the company's conference call, which kicks off in just just about an hour from now, the stock is down 5.25%. A miss on those online sales numbers, the e-commerce business, which of course is core. Plus, the CEO of medical technology company Hologic on whether his company is seeing a surge in COVID testing because of the Delta variant. We'll be right back.
Amazon moving lower after reporting mixed earnings earlier this hour. The company beat on EPS but missed on revenue, as well as gave light third quarter revenue guidance. Joining us now to break down the numbers is CNBC contributor Ed Lee from the New York Times and Tom Forte from D.A. Davidson. Good to see you both. Tom, it looks like you were at about $116 billion forecast for the second quarter. Revenues came in a few billion light of that. Where did they miss? What were the soft spots? What would you like to hear on the call?
Sure. So I'd like to hear on the call as to what extent this is a reflection of maybe supply chain related issues, things of that nature. Did they see consumers lean into travel and lean out of buying more items? So is it a macro level? Is it company specific? The profitability is obviously very good. The cloud computing sales were very good. So what are their thoughts at a high level and what they're seeing as far as consumer behavior went? You would have thought with Prime Day in the quarter, perhaps expectations just got too much ahead of themselves. But look for additional details and not exactly the first quarter that Andy Jassy was hoping to have as CEO.
Right. Yeah. Actually, Ed, to that point, on the one hand, it seems like a little bit of a bumpy opener for a new CEO. On the other hand, maybe the bar is a little bit lower. You can be conservative about the guidance. And I just wonder what it does about the conversation around, the business mix at Amazon. Should it stay in its current form? I mean, I know this is, big picture stuff, but it all really comes to light when you see the divergence in the performance of the different parts of Amazon.
No, I think that's the right way to put it, the framing. I mean, if you look at AWS, I mean, it did really, really well. And of course, that's where Jassy comes from. So if you want to focus on that, great job. If you want to focus on the core business, though, which is still e-commerce, I mean, the question I have, I agree with what's been said here that, is there a certain saturation point that they're hitting in North America, right? Sort of e-commerce sales grew 22%. I mean, that's kind of light if you think about it. Also, the fact that there was Prime Day or 2 Prime Days basically in the quarter, and it didn't really seem to sort of boost the top line on that. That is a little bit concerning, a little bit worrying. At the same time, I mean, there are certain segments outside of AWS that are also doing really well. Their advertising business, which is they call their other segment, that grew really, really rapidly, 87% in the quarter, 7.9 billion. You couple that with their subscription business, which is that the Amazon Prime sort of subscription price that they get, that exceeds AWS just from a gross sales perspective. So that is actually very interesting. So I'd like to get a better sense of how that's performing, those segments are performing. And yes, what is this? Are you hitting that saturation point in North America? And so therefore, how much more important are overseas markets for your e-commerce? Looking at India, looking at South America and Europe, of course, is that ramping up enough?
Tom, some of these big cap names, are influenced by COVID-19 for better or worse. Google was obviously a big winner now because it's exposed to advertising, which is more cyclical, so it's capturing the upside. Some of these others, Pinterest, for instance, saw declining users, in part because users had shot up during COVID. Where does Amazon fall on that spectrum, and could that help explain the miss here on e-commerce sales?
Yeah, it's a great question, but the way that I was thinking about it was for Amazon, if you go back to the early days of the pandemic, they were not able to keep up with demand. So since then, they've added more square footage at the fulfillment center level, more headcount to better keep up with demand for e-commerce. So that makes me wonder if there is something else going on here, either consumers leaning into travel or the discretionary things they weren't able to do during the heart of the pandemic, or an inability to meet demand and perhaps a hangover from that, to the extent that some consumers may have shifted consumption perhaps permanently to Target, Walmart. Look for additional details in the call to that end on both.
Yeah, and Ed, I don't know that this necessarily informs the broader kind of regulatory push, or the sense that Amazon can kind of do no wrong and at will they can dominate different areas when maybe they've fallen short of expectations in one quarter. But clearly that's something that's going to be accompanying the Amazon story for a little while now under Jassy.
Yeah, that's a fair point, and it's sort of, just to put it in perspective, I mean, the company's still booking tons in profit and revenue, and it's still falling short of Wall Street expectations. So there is sort of a mixed reaction if you think about it. If you're Lina Khan at the FTC, you don't care necessarily what the Wall Street reaction is. You care how dominant you continue to be, and Amazon does continue to be dominant. And it does raise the question. For example, if you broke out AWS as a completely separately traded business and stock, would it be worth more? Could those profits be pumped more back into AWS versus going towards a larger portfolio of businesses across Amazon? So these are interesting questions that just even from an investor standpoint, you'd want to sort of take a closer look at.
Down 6% now after hours, Tom. It hasn't stopped them from expanding even further. They're trying to buy a Hollywood studio, MGM, which is being looked at by the FTC. They're obviously investing in the physical stores and in Whole Foods. Where does this regulatory threat take Amazon? Where's the street on it right now? Because the stock has been really strong into earnings. Is Wall Street
So
ready
I would
to
argue
dismiss
when you
it?
think about both the legislation being considered in the House and Senate and then the executive order by President Biden, that up until recently, the market wasn't giving enough attention to the regulatory risk, antitrust risk for Amazon. I do think that we are going to see a more services-oriented Amazon led by Andy Jassy. They'll focus greater attention on third-party sellers on Amazon versus their own first-party sales. That bodes well for profitability. But I do think that, generally speaking, the market has not been paying enough attention to the regulatory risk, which I think is the most significant for the stock over the next 12 months.
All right, Tom, Ed, thanks a lot for breaking it down for us. Appreciate it. Ed Lee and Tom Forte.
Sure, anytime.
Meantime, Robinhood shares falling 8% during its Wall Street debut today, but its founders are still making billions from the IPO. We will break down their new windfall of wealth straight ahead. Plus, NBA star Kyrie Irving is trashing Nike over the latest edition of his signature sneaker line. Details on that later on Closing Bell. for a CNBC News update with Shepard Smith. Hey, Shep.
Hi, Mike. From the news on CNBC, here's what's happening. President Biden making a big push to get federal workers vaccinated, announcing just moments ago sweeping testing, masking, and distancing requirements for federal employees who do not get their shots. In fact, he's still speaking live. The president calling on state and local officials to offer people $100 as an incentive to get that vaccine. The announcement on vaccines, by the way, came in late today, started later than scheduled, because the president was said to be joining the First Lady at Walter Reed Medical Center. Her office reports she was having a procedure to remove an object stuck in her foot. The White House says the injury happened last weekend while she was walking on a beach in Hawaii. And the U.S. gymnast Suni Lee thanking coaches, family, and supporters for helping her win all-around gold at the Olympics. The 18-year-old became the 5th straight American woman to claim that title. Tonight, the heartwarming story of Suni and her father, the bond that got her to the top, and the 2004 all-around gold medal gymnast Carly Patterson is with us to talk about Lee's big win. On the news, right after Jim Cramer, 7 Eastern, CNBC. Sarah, back to you.
My favorite sport, women's gymnastics.
Fantastic.
Shep Smith, thank you. Look forward to that. Robinhood closed lower today, about 8% after its highly anticipated IPO. Our Robert Frank is taking a look at the billions in wealth gained by the company's founders, Robert, despite the fall today.
Yeah, Sarah, that disappointing opening for that stock, down about 8%, but still creating a huge amount of wealth for its two founders, co-founder Vlad Tenev and Baiju Bhatt. Both own around 8% of the company, so they are each worth now around $2.3 billion. That's the latest trading price. But the real payday could come in the next few years. That's because the Robinhood board back in May approved a special compensation package for both founders that gives them millions of shares if the stock reaches certain levels. So over the next 8 years, the plan would give them, or at least 10 of shares of restricted stock worth about $4.7 billion. Bhatt would receive shares worth about $2.8 billion. In an SEC filing, the company said the awards are aimed at incentivizing the founders to grow our share price. Now, they start to receive the shares if those shares hit $120, and they receive all of them if the price hits $300. That would give the company, at $300 per share, a valuation of $250 billion. That is a long way off, given that the market cap right now after closing is only $29 billion. Guys?
Yeah, Robert, I mean, clearly that's almost a 10-bagger from here, so maybe that's your stretch goal to get the full incentive compensation there. But it is interesting that right out of the gate, it's mostly stock price targets that are basically being weaved into the company. In other words, it's not necessarily as much on operational performance metrics.
Yeah, and that's in keeping with a lot of the tech companies that have gone public recently or just given compensation. You look at Elon Musk's compensation package, and yes, there are other metrics, but the main one is the market cap and the stock price over certain periods of time. So that kind of is the new compensation model. It's interesting you mentioned 10-bagger, because I look back at Facebook when they IPO'd that day, and remember that was down for them as well on their opening day of trading. That market cap was $100 billion. Today, they are at over $1 trillion. So they 10-bagged it over about the same period as these options would take place for these two founders. So it's not impossible, but they would have a long road ahead here for Robinhood to get 300 eventually over the next 8 years.
That's right. And Facebook was basically cut in half over the first 6 months of that, so it had even longer to come back over the last 8 or 9 years. Robert.
Yeah, that's right.
Thank you very much. Appreciate it. Shares of Hologic rising on the back of strong earnings. That stock ending the day up 2.4%. Up next, the CEO will join us with his take on how the changing demand for COVID-19 testing has impacted Hologic's bottom line. Closing bell, we'll be right back.
COVID cases, hospitalizations, and deaths on the rise across the country. The 7-day average of cases and hospitalizations increasing in almost every state. Only Wyoming showing a decline in cases week over week. COVID test maker Hologic reporting third quarter earnings yesterday, showing revenue growth of 42% despite decreasing demand for its COVID tests. Joining us now for an exclusive interview on CNBC is Steve McMillan, Hologic CEO. Welcome back to the show, Steve. Good to have you.
Sarah, thanks for having us back.
So clearly you are making money now on other tests that you do, like mammograms and everything else. Give us a little color on what you're seeing now that the Delta variant is surging across this country.
Sure. I think, it's disappointing, certainly to some degree from a societal standpoint. We were excited to see all the rest of our businesses getting back. And frankly, a lot of the testing we do for sexually transmitted infections, as well as mammograms and things that you said, and a lot of women put off their, call it well women visits during the time. So it's been nice to see people getting back into that. And now this recent uptick may see some trade-offs there. So, our core business is focused on women's health. We toggled to provide and make a huge difference, obviously, on COVID tests. They were coming down, the last few weeks. We've certainly seen a little, higher demand, but nothing like it was back last winter. And truthfully, while it would be good for our business, we'd rather not get back to those levels.
Yeah, amen. Steve, how much of the business is COVID testing since you've done this big pivot during COVID-19? What portion of it does it make up?
Sure. In the last quarter for us, it was about 30% of our total business. It peaked at close to 50, and pre-COVID it was 0. So we clearly, I am so proud of our teams. And when a lot of people hunkered down and stayed home, our teams came to work every day. I've been in the office every day for the full last year and a half alongside our teams who came to work to make tests. And, we're just so proud of them. And now we're getting back to a little more of a normal production schedule versus the 24/7 that we were running all through last cold and flu season.
Steve, you mentioned that obviously a lot of people had deferred normal preventative treatments or procedures and things like that. What have you seen recently? Has there been any backsliding on that after the reopening, just because people being wary of, again, getting to doctor's offices, or is it not really evident?
For the most part, other than tiny little pockets, I think people really are getting back to having their procedures. And it's particularly important, particularly, frankly, even in the inner cities. I think one of the big things we've seen is women's health during the time of the pandemic probably took a step back overall, but especially, frankly, in some of the inner cities where a lot of the inner city clinics that often do, STI testing and other things devoted 100% of the resources to COVID testing. And so I think for all of us, we need to, ultimately what we've got to be able to do in society here is figure out we've got to coexist and try to drive COVID out, but it's not going to get to 0, right? As all viruses mutate, the positive that's not really being reported is typically as they mutate, while they spread quicker, they go down in virulence or become less lethal. But I think we've got to understand they're going to be there. We're not going to get it to 0, especially because we're not going to inoculate the world. We're trying to get vaccines for some of our employees in other parts of the world. So we've got to learn how to manage through this, and I think we can continue to do that. But it can't be shut everything off in, one area just to focus on COVID. We've got to be able to do both.
I feel like that was a big takeaway for a lot of folks. Steve, just remind us what kind of COVID testing you do and whether they're being used appropriately. Shouldn't we be at a point where we're using more testing if only 50% of the population is vaccinated, just to do things like open up offices and schools on a daily basis?
Sure. My wise guy answer would be that we're the ones that make the tests that work. But we do make the high throughput molecular tests. So the ones that are used by the Quest, the LabCorps, and we have about a 3-hour turnaround time on our Panther instruments, which is the high throughput, highly automated system. So we're able to get the most accurate results. And what's very important, and where so many of the tests have been misused over time, is our test is also approved for asymptomatic pickup. So what happens with a lot of the rapid tests, they don't necessarily detect asymptomatic people. So the magic is really having the underpinnings where you are testing, and we're testing both symptomatic and asymptomatic people with tests that will pick up the proper diagnosis. And I think for the most part, we've really evolved there, very nicely, frankly, I think really particularly in the United States, where in the beginning there weren't enough molecular tests and there were those huge backlogs and people were throwing everything out. And I think we've gotten to a pretty good place right now.
Yeah, that's a better spot to be in. Steve, thanks a lot for the update. Appreciate it.
Great. Thank you, Mike. Thank you, Sarah.
All right. Up next, big oil ahead. Chevron and Exxon set to report tomorrow. The key metrics to watch after the break. Let's get a check on this afternoon's biggest movers. Amazon shares moving lower, down now almost 7%. The company reporting a big earnings beat, but it did miss on revenues. Pinterest reporting a beat across the board, but the stock plunging on weak monthly active user numbers. That stock down now 17%. T-Mobile also beat. The company raised its guidance. Stock started up, now down 2%. And Gilead topped estimates on both the top and bottom line, also down about 2%.
Looking ahead, tomorrow is shaping up to be another busy day for earnings. Brian Sullivan watching the big oil names, Chevron and Exxon, and Christina Partsinevelos is covering Caterpillar. Christina, kick it off for us. What should we be watching for CAT?
Let's talk about this mining and construction equipment behemoth that previously beat estimates in each of the trailing 4 quarters. Tomorrow, we will be expecting earnings per share at $2.40 on revenue of 12.58 or $12.6 billion, showcasing possible accelerated growth compared to last year at this time. But construction is what accounts for a major chunk of revenues, and it's expected to improve because of ongoing strength in residential construction here in North America, along with strong demand from China. Improving commodity prices have also benefited miners, which could translate into higher order levels for CAT. And Caterpillar is also seen as a China proxy, given it was one of the first industrial giants to open up shop in China. So we'll be looking for comments from the CEO about China's recent regulatory crackdown and its effect, if any, on U.S. corporations.
Christina, thank you.
Thanks.
Brian Sullivan, meantime, watching Chevron and Exxon. Brian, what should we be watching for here?
All right, so Mike, yeah, they are out tomorrow morning, both of them. And yeah, the EPS and revenue numbers are going to matter, but not as much as this. Capital spending plans, that's everything. If they boost those spending plans, it could boost the entire services sector. Also, their oil output, are they going to increase production themselves? And of course, analyst reaction, price targets on both guys are above where the stocks are. They don't like what they hear. Do they downgrade the name? Do they reduce the price target? By the way, I am out west because tomorrow on the exchange, we're going to have a long-form exclusive with Chevron CEO Mike Wirth out at their headquarters across the bay. We're going to talk about the current state of oil and gas, energy transition, the electrification of America, and much, much more. That's at 1:05 p.m. Eastern Time live on the exchange. Meantime, those numbers, we'll hit them nice and early, about 4 a.m. Pacific time tomorrow morning, guys. Back to you.
All right, nice shot there, Brian Sullivan. Thank you. Basketball star Kyrie Irving blasting his longtime sponsor, Nike. The Nets guard taking to social media yesterday to say he had nothing to do with the design or marketing for the upcoming Kyrie 8s. He goes on to say, in his opinion, quote, "They are trash." This is a big deal. Kyrie's signature shoe line is the top-selling basketball sneaker for Nike, according to NPD Group. He sells more sneakers than LeBron James, in part because he's younger. Also, his shoes have a more accessible price point in the $130 range. Nike is not commenting on the story, but our sources tell us both Nike and Kyrie's own team were caught totally off guard by these comments. Irving reportedly makes about $10 million per year from his Nike contract, putting him in line with Kevin Durant, Paul George. Kyrie first signed his contract with Nike back in 2011. He's got 2 years left on the current deal. And the only other thing I'll say about it is that he makes extra money when he sells more shoes.
Right.
So he's kind of shooting himself in the
Right, he has no interest in trying to, deter people
which
from
his
buying
fans
it.
say is, him being genuine
Sure.
and forthcoming.
Is he responding to some kind of social chatter about the quality of the shoes, or is it just his assessment
he
of
was
them?
trashing the design.
Yeah.
Literally. So anyway, Nike stock went up. Wasn't pleased by that, but it is
Takes
a big
a lot to
deal,
move Nike,
big
but yeah.
shoe for them. I want to briefly return to Amazon
Sure.
because the stock is getting hit pretty hard here after hours on
Yeah.
that revenue miss.
And it's another test, right? We already saw that we absorbed the kind of the Apple disappointment, the sell the news on Facebook, Microsoft, nothing great, Amazon, a fourth one. You actually are starting to see things like the index ETFs price in a little bit of a down move in the morning. So it's not just Amazon. People are wondering if, we're up for the month, we're up for the week. See if we're going to give a little bit of that back because, Amazon had been that stock that was just breaking out after about a 9 or 10 month sideways.
Not a great first quarter for the brand new CEO Andy Jassy to come out with that, even though it's a huge beat on the bottom line. I guess I wonder just how much they're going to blame it on COVID. And
Sure.
They had such high growth rates for their online business this time last year and in the previous quarters.
COVID and logistical and supply chain issues. I mean, obviously, it's always been, the hard part for Amazon is getting everything where it had to be. They had some issues back, even last year, getting things to customers. UPS obviously had a big stumble this year. So a lot of this is pretty staticky in terms of the message, but maybe the call is going to, give us a little bit of clarity. I know it's
Is it
going on.
transitory? I
That's
think
right.
it's a question of the
Pretty
moment.
much the question for everything,
And
yeah.
stocks went up again today. We're higher now for the week going into a Friday.
Yeah.
Momentum is strong.
The momentum is in the right direction. I do think, again, we're sort of like slowing down a little bit, and we pull back in the afternoon. So just see if maybe we get an end of the month kind of a lock it in type move tomorrow morning.
Well, I'm happy to have you here today and
thrilled
tomorrow.
to be with you, yeah.
Wilfred's back next week, and that's going to do it for us this evening on Closing Bell. Fast Money picks up the coverage, including those big earnings movers right now after this short break.
I'm Melissa Lee, and this is Fast Money. Tonight's trader lineup: Dan Nathan, Guy Adami, Tim Seymour, and Karen Feinerman. Tonight on Fast, one of the hottest IPOs of the year falling in its first day of trading. We're breaking down the action in Robinhood with one of this company's first investors, Tim Draper. His take on the blockbuster debut. Plus, stocks touching all-time highs today despite a bomb of a GDP print. We'll dive into how our traders are playing this record rally. And later, a streaming smackdown. Hollywood A-lister Scarlett Johansson suing Disney over the release of Black Widow. Why the fallout could be a game changer for the entire streaming space. We start off with an earnings alert on Amazon. That stock is sinking in the after hours after reporting results. Conference calls kicking off in just about 30 minutes from now. Let's get straight to Deirdre Bosa, who's got the details. Deirdre.
So, Melissa, it's really that top-line miss and its revenue guidance for the third quarter that has that stock sinking in the after hours. I also just got off the phone with Amazon CFO Brian Olsavsky for a few more details on the quarter. He said that step down in growth we saw this quarter is likely to persist for the next few quarters as they lap a high period of growth, of course, last year during the pandemic. He said that once we lap growth on May 15th, see the business growing mid-teens percentage. Part of that is the lapping and the mobility of customers in the U.S. and Europe, that is people getting out more. He also said that they are still aiming to return to the office in September, and Amazon will not be mandating vaccines. So this is a bit of a departure from what we've heard from the other tech giants, but keep in mind that Amazon is the second largest private employer in the United States, so a vaccine mandate from the company would be a much bigger deal, perhaps also trickier. He said that wages are one of the bigger elements of inflation in the business right now. Advertising business, just want to call out as well, because that grew 73% this quarter. And Olsavsky told me that the step up was due to demand bouncing back, sort of like we saw at Google, Facebook, Twitter, Snap. The call, as you said, Melissa, kicks off in about 30 minutes. This is the first quarter with Andy Jassy at the helm. Bezos was never on this call for years. We will see if Andy Jassy takes a different tact and if we'll hear from him. Back to you.
But just to be clear, Deirdre, this is the last quarter under which Bezos was the CEO. This was Bezos's quarter, even though Jassy is now at the helm.
That's a very good point. He just took over Jassy at the beginning of July when Bezos went to space. So this is a tough quarter maybe for Jassy to talk about. This is the first revenue miss since 2018. But going forward, it would be great to hear how he plans to sort of tackle this more difficult period of comps, especially given the pandemic last year.
Good time to retire. Deirdre Bosa, thank you. Keep us posted. Deirdre Bosa on Amazon. Guy Adami, let's get your first take on Amazon. These are questions we had for all of the tech giants going into this particular quarter. How is it going to deal with very tough comparisons? A lot of similarities here.
Point that Karen's been bringing up a number of times, the setup in earnings was not great, and she's spot on here. I mean, Amazon 3 days ago was trading 37.70-ish. Look at where it is now. I looked at this quarter and said, wow, 23% beat on EPS. All right, revenue miss, I get it. Margins have got to be better. At least margins should have improved, and margins came in line. And then I called Dan and said, Dan, what's the deal? He goes, it's probably the product mix, and he's spot on. And then this guide, which I'm sure all three of the guys and gals can talk about, the guide is just horrible. So the question now is, where do you get back into the stock? Well, the last 2 quarters had big run-ups, 35.50, failed both times, traded one time down to 2,900. I don't think we're going to get there this time, but there's probably further room to the downside in this name, despite the move in the after hours.
Yeah, and the question surrounding growth, I mean, let's be clear, Amazon still has amazing growth, Dan, but the question is, at the price which it is right now, is that growth priced in? And is it priced in for a few quarters ahead of a slowdown in that growth rate?
Well, maybe not where it was just the other day, right? Very near all-time highs. The stock in early July broke out above that 35.50 level, and it just kept on going. It's running away breakout. So to Guy and Karen's point that she's been making, it's just the expectations were really high. I guess you got to go back and look at 2020. This is a company whose sales grew 38% in 2020, okay? So that's why those comps are really difficult. The CFO just told you they're seeing this deceleration. I think it said somewhere in mid-teens. Is that what Debo just said? I think the stock will figure figure it out. I think investors will be somewhere, happy towards those levels that Guy just said. It's down 7% in the aftermarket. That is a massive move for a $1.8 trillion market cap company. But look at that chart right there. You look at that consolidation. I think a lot of investors, and the reason for the year-to-date underperformance by Amazon is that smart investors were already pricing this in. They realized that the comps were going to be amazingly difficult. So to me, I don't think there's any big problem, and I think there's probably an opportunity to buy this thing if you get back towards those levels from a couple months ago that the stock had run 20% from. So, somewhere in that range that Guy just mentioned.
Yeah, maybe that consolidation was, in fact, waiting for that guidance when we're lapping very tough pandemic comparisons. Karen, what did you make of the quarter?
So much of what the guy said, I thought actually the guidance, which was lighter than the street was hoping, that doesn't really bother me. I mean, we've seen them be conservative with guidance many, many times. It was more, I want to get at the margin question, which Dan and Guy both brought up. That I want to see what really went on there. I know there were maybe some additional expenses. The free cash flow looked a little odd to me. I don't know if that's just noise around additional accounts receivable and lower accounts. I'm not exactly sure what happened there. I want to see that. I don't know that the story is very different at all here. The one part of the story that was, the two parts actually that were good were AWS. That was some very nice growth. There was a good beat there. And advertising, which is a smaller part. But it doesn't materially change the story to me. It does actually make me think on a more macro about where we are in the pandemic and the reopen, right? Is this a change of behavior? Is this, is this a permanent change of behavior? I know we'll get to Pinterest, but that also speaks to that same point. So I wouldn't be surprised if we see Amazon clearly will trade down tomorrow. At some point, I'm going to look to buy more. But what are the other, the reopen trades, something like a Peloton, is that going to be under pressure if this is really happening?
Yeah, and not only did the engines of growth, AWS as well as advertising, the sales growth there not only beat consensus, but also showed a sequential acceleration, Tim, for the second straight quarter. So that's important. I mean, those are the areas that investors are invested in Amazon for, not necessarily Whole Foods. All that's nice. But how do you interpret this quarter with where the stock is?
Well, I think a stock that ran 15% or so, even though it's been somewhat sideways and actually down slightly on a 3-month basis, tells you a little bit on the price action. But yeah, look at this on a 2-year basis. And as I think some of us are saying, in fact, I think Dan sounds surprisingly enlightened on this. I don't mean enlightened. He says a lot of enlightened things. I mean, he's actually saying, the sky's not falling here. I agree with that. I mean, if you look, and we were doing a 2-year stack review on Facebook yesterday. Let's do it on Amazon. We're about, like that third quarter, we're about to go into our second COVID comp for Amazon, and it's not going to be pretty, but the operating income is going to be up 75 to 80% year over year. AWS up 45%. Those ad services and other up 88%. So I think actually Amazon is growing into the valuation. I think Amazon can pull some of the leverage. Remember also, the AWS wasn't really the disappointment here, but in the past, that's really the place people have been most focused. So no, if you're Amazon, you can't miss the revenue line, especially after you've run. But I think these are great times to be Amazon. It's not getting worse for them, it's getting better.
All right, pause on Amazon here. We got breaking news on Procter & Gamble. Sarah Eisen's got the latest. Sarah.
Announcing a new CEO, Procter & Gamble, the consumer packaged goods giant, says that John Moeller, who's the longtime CFO of P&G, recently the vice chairman of P&G, will become the CEO as of November 1st. David Taylor, the current CEO, will stay on as executive chairman. This is considered a pretty seamless transition. The two of them have been aligned for a long time. Moeller has been at the company at P&G since 1988. He was CFO for 12 years, and then more recently he was elevated to a bigger position where he oversaw all of emerging markets. He's been part of all the transitions at P&G, including the latest one, which has totally restructured the business and streamlined it, which has actually set up P&G for success, and it has been outperforming its competition and taking market share. So Moeller is kind of a natural fit to take this. If you were paying attention, if you're an investor, you won't be so surprised. Perhaps a little surprised on the timing. David Taylor's been the CEO for 6 years, but he did what he set out to do, which is he restructured this company and set it up for success. And so it is a good time to step out on top at a time where P&G, as I said, is growing market share and does. Remember, after they had that Nelson Peltz fight where he finally joined the board, there was a lot of criticism about the matrix structure. They totally reorganized that, and it has really helped them outgrow the category. P&G's underperformed the market lately, Melissa, but that really has to do with the fact that it's a consumer staple and it's lapping tough COVID comparisons. It's also dealing with inflation. The company reports earnings tomorrow morning. So this is coming at a time, obviously right before then, where they can get on with investors and talk to them about it. But I would assume that investors and analysts would be happy about this news because Moeller is no stranger at all to that community and has been well liked for a long time. It also continues P&G's longtime tradition of appointing from within, not having an outsider coming in and run this business. They usually stay pretty close to home in Cincinnati. And as I mentioned, Moeller's been there for a very long time.
All right, Sarah, thank you. Sarah Eisen with the latest on Procter & Gamble. Let's get back to Amazon, whose shares are trading down by about 7% after hours. Bring in fast money friend Gene Munster of Loop Ventures. Gene, great to have you with us. A lot is being made. A lot of the stock reaction is on the back of a perceived sales miss. You make a very interesting point in terms of what this miss actually is. It sounds like you think it's more of a Wall Street analyst miss as opposed to a company miss.
Right, we should have listened to their guidance. They hit it right in the middle, and it implies if we take that learning and apply it to the September quarter, they'll grow at 18%. That's compared to 27% in the most recent quarter. That means that they guided down by 8%. So just kind of a level set there when we talk about these difficult comps. They just got it down by 8%. And why I think that that's an important starting point to your entire conversation here is that we need to think about what the arc of growth is for next year. The Street's currently looking for 19% before this report tonight, 19% revenue growth. But if you start to take Tim's play into action, which is looking at the stack in the back half of 2020 or 2019, and compare that to the first couple quarters of 2022, that two-year stack, effectively you're probably going to get estimates coming down around 15%. So maybe as a starting principle here, I would say investors kind of get comfortable with Amazon growing at 15% next year. And I would like to just kind of continue the thought and on terms of the guidance and what this all means together. There's a bigger question at play here, and you've been touching on it around profitability. There's the comp question that has circled, Melissa, as you've said, every tech company this reporting season, but the margin is a really big deal. Right now, Amazon doesn't have tech-like margins. It's funny because we criticize Tesla for not having tech-like margins. Amazon's operating margins tend to be between 6 and 8%. Apple and Google more recently were 30%. If you look at what Facebook was at, 40%. And so I think that there is a bigger question for Jassy here is what are you going to do to show some margin improvements in the years to come?
Hey, Gene, do you think this is a deliberate reset on Jassy's first quarter as the company's CEO?
I think it played into it, that 8% guide down. If we look at typical guide downs, they do guide down in a half of the occasions, so it is half the time that happens. But usually the guide downs are more at the 3 to 5% level. This is at 8%, so I suspect he probably influenced some of that. I can say if I ever had the honor of having his job, I absolutely would do it. I probably would have guided 15% below the Street to make myself look good for the next few quarters. But I think that played into it.
Hey, Gene. I'm sorry. Hey, Gene, it's Tim. How about AWS versus the core e-commerce business? And we talked a little bit about ad revenues, et cetera, but where should we be focused? Because at times it was really all about AWS growth. That did not look terribly disappointing. The comps are tough there too. Where are you focused?
I'm focused on, curtain number 2 here, which would just be around efficiencies, like we talked about. Is that the core e-commerce business slowed to 13% unit growth. It had been growing in the 40 to 50% range in the previous quarters. So big slowdown there. As you said, AWS has been rock solid. It's still relatively small, 10, 12% of overall revenue. But one thing that impacts all of the revenue is around margin. And I think that an area that I hope they talk about is automation. Amazon has 1.2 million employees. The majority of those are in logistics. And ultimately, I think if you fast forward this 5 years from now, I would like to hear the company adopt a position about putting people first, but also finding ways to greater automate the business. It is a massive operation that is ripe for automation.
Gene, always great to have you with us. Thank you.
Thank you.
Gene Munster. Let's trade Amazon. Let's trade Amazon in the context of what we've gotten so far. Basically, we have the entire big tech complex having reported. Tim Seymour, how do we digest this? There have been basically nits to pick in every earnings report except for maybe Alphabet.
Well, look, Amazon came into this under-owned and under-loved. It's going to come out of this even more so. I look at the underperformance to the group, and that gets me excited as an investor. I've never ever been terribly comfortable with their valuation, but I'm extremely comfortable with the ability that they can pull levers, become more profitable, again, increased operating income, and I think their subscription services, and Gene talked about where they could become a much more efficient company. But from a trading perspective, look, this is a company that of that five is not in the top echelon, and that's something you want to own as an investor, isn't it?
Yeah, Guy?
It's interesting. The last 2 quarters for Amazon were extraordinary, I think, by any stretch. And both times, the stock traded up initially, then a week and a half later was significantly lower. This quarter was nowhere near the last 2 quarters. And oh, by the way, the guide was disappointing. So you have to ask yourself, if the last 2 quarters it sold off in a meaningful way, what happens now? I think Tim makes a good point. I mean, maybe we're sort of finding some equilibrium, but you got to believe there's still some downside room given what we saw the last 2 quarters.
All right, 14 minutes till that conference call kicks off. We'll keep you posted. Meantime, we got a news alert on Disney. Let's get to Julia Boorstin with the details there. Julia.
So, Melissa, Scarlett Johansson is suing Disney, alleging her contract for Black Widow, the Marvel film, was breached when Disney simultaneously released the film in theaters and on Disney+. So she said she was guaranteed an exclusive theatrical release, and her salary was based on box office performance. The Wall Street Journal estimating that the film's simultaneous release on the 2 platforms could cost Johansson some $50 million. Now, Disney just responding in a statement telling us, quote, "There is no merit whatsoever to this filing. The lawsuit is especially sad and distressing in its callous disregard for the horrific and prolonged global effects of the COVID-19 pandemic. Disney has fully complied with Ms. Johansson's contract, and furthermore, the release of Black Widow on Disney Plus with Premier Access has significantly enhanced her ability to earn additional compensation on top of the $20 million she has received to date. Now, the film grossed about $80 million at the U.S. box office and another $78 million overseas, plus $60 million from home purchases opening weekend. But the box office then fell 68% in its second weekend. That is the biggest ever first to second week drop for a Marvel movie. Now, it could be because COVID discouraged audiences from going out to theaters, or perhaps the at-home option cannibalized the box office. Now, how this all plays out now could have long-lasting implications for how studios compensate talent, perhaps with more pay tied to streaming revenue, or just simply pay upfront. Melissa?
If talent, Julia, is compensated more in line with streaming, in other words, they get a bigger cut of the streaming revenues, then does that make that whole notion of a simultaneous release or an earlier streaming release much less profitable?
Not necessarily. And we also have to remember that each of the studios is basically doing this totally differently. So you have Universal, which is putting its films in theaters for a minimum of a 17-day or 3-weekend exclusive window. So Universal might say, and they probably have said, that they would tie box office back end, that's basically the box office bonuses that content creators and movie stars get. They would tie that to the time in theaters and then tie the bonuses after that to the number of sales that they can do in terms of the number of people who decide to pay for downloads. Disney is also doing paid downloads, so that's pretty clear. You could give talent a percentage of that. But remember, you have HBO Max, which for this year at least is giving the movies away for free on HBO Max. So you can't give a percentage of streaming subscriber revenue, or maybe you could, but it would be complicated. But each of these studios is doing things differently. They know they need the movie stars, but maybe, Melissa, the day and age of huge box office back end, maybe that day is coming to an end.
All right, Julia, thank you. Julia Boorstin. I don't know how this all shakes out. I don't think anybody knows, Karen, but it is clear that they'll figure it out. They'll figure it out, and the movies will go to streaming, because that is where the premium is right now.
Right. I think I'd be really interested actually in the backdrop of how this came to be a public spat. It is my strong suspicion that they really wanted to settle. This doesn't do anything good for either of their reputations to have this public fight like this. I think it's probably going to end up, if you see how Netflix model is, when they do a deal with Shonda Rhimes, they pay an enormous amount up front, and that's it. They own it. And I wouldn't be surprised if we see a change in how talent is paid as well. Big money up front, you don't own anything, it's very clear.
Yeah.
That wouldn't surprise me if that's how this shakes out.
I would think that sort of be better for talent in terms of the value of money and being able to invest it up front, right? Dan, what's your take on this whole thing?
My take is that Black Widow chose violence. I mean, like, literally, this is like a pretty aggressive move. I think it probably has something to do with the fact that this was her last movie with Marvel. I don't think that any of those people who hadn't been killed, sorry for the spoiler alert in Endgame here, people, would be suing the studio like that, because these have been amazingly lucrative things. But you can empathize with her a little bit. This was her kind of solo act. Here, I think it does change the dynamic for talent going forward. Like you said, Mel, I don't think any of us know what's going on, but I just heard that report from Sarah Eisen earlier today that Kyrie Irving came out with a statement about Nike's Kyrie 9s, calling them garbage. You know, so I guess we live in a world right now where some of these big stars can really flex the way they want. They can speak directly to the people, their fans, and they have a lot more say in which, you know, they're going to do business with these sorts of big brands anyway.
Yeah. Coming up, the Robinhood reality check, the stock falling in its market debut. Is this a name you should own? We'll break that down with our traders. Plus, you'll hear from one of the company's earliest investors, Tim Draper. Plus, Pinterest is plunging, the stock falling hard in the after hours on earnings. We're breaking down the results next. Welcome back. We are watching shares of Pinterest plunging in the after hours on earnings. Let's get back to Julia Borson with the details. Julia.
Well, Melissa, Pinterest may have beaten expectations on the top and bottom line, growing revenue 125%, but those shares are plummeting down nearly 18% right now on user growth. It not just fell short of estimates, but actually a user number that fell between the first and second quarter. The company was expected to add 4 million monthly active users between the first and second quarter to end with 482 million. But instead, the company actually lost 24 million monthly active users, ending with 454 million. And while third quarter revenue guidance was in line with expectations, the company warned that headwinds around those user numbers continue into Q3, saying that from July 1st through the 27th, that was Tuesday, U.S. monthly active users declined 7%, while global users grew 5%, saying
So we have the earnings call starting at any minute now. If you have just joined us, this is the time to hit that like button and subscribe to the channel. Seems we're about to start. Let's tune in.
Thank you for standing by. Good day, everyone, and welcome to the Amazon.com Q2 2021 financial results teleconference. At this time, all participants are in a listen-only mode. After the presentation, we will conduct a question-and-answer session. Today's call is being recorded. For opening remarks, I will be turning the call over to Director of Investor Relations, Mr. David Fildes. Please go ahead.
Hello. Welcome to our Q2 2021 financial results conference call. Joining us today to answer your questions is Brian Olsavsky, our CFO. As you listen to today's conference call, we encourage you to have our press release in front of you, which includes our financial results as well as metrics and commentary on the quarter. Please note, unless otherwise stated, all comparisons in this call will be against our results for the comparable period of 2020. Our comments and responses to your questions reflect management's views as of today, July 29th, 2021 only, and will include forward-looking statements. Actual results may differ materially. Additional information about factors that could potentially impact our financial results is included in today's press release and our filings with the SEC, including our most recent annual report on Form 10-K and subsequent filings. During this call, we may discuss certain non-GAAP financial measures. In our press release, slides accompanying this webcast, and our filings with the SEC, each of which is posted on our IR website, you will find additional disclosures regarding these non-GAAP measures, including reconciliations of these measures with comparable GAAP measures. Our guidance incorporates the order trends that we've seen to date and what we believe today to be appropriate assumptions. Our results are inherently unpredictable and may be materially affected by many factors, including fluctuations in foreign exchange rates, changes in global economic conditions and customer spending, world events, the rate of growth of the internet, online commerce and cloud services, and the various factors detailed in our filings with the SEC. This guidance also reflects our estimates to date regarding the impact of the COVID-19 pandemic on our operations, including those discussed in our filings with the SEC, and is highly dependent on numerous factors that we may not be able to predict or control, including the duration and scope of the pandemic, including any recurrence, actions taken by governments, businesses, and individuals in response to the pandemic, the impact of the pandemic on global and regional economies and economic activity, workforce staffing and productivity, and our significant and continuing spending on employee safety measures, our ability to continue operations in affected areas, and consumer demand and spending patterns, as well as the effects on suppliers, creditors, and third-party sellers, all of which are uncertain. Our guidance also assumes, among other things, that we don't conclude any additional business acquisitions, investments, restructurings, or legal settlements. It's not possible to accurately predict demand for our goods and services, and therefore our actual results could differ materially from our guidance. And now, I'll turn the call over to Brian.
Thank you for joining us today. Before we get to Q&A, I'd like to first thank all of our Prime members, our vendors, our 3P sellers, and my Amazon colleagues, especially the Worldwide Ops team, for a record-breaking Prime Day in June. Third-party sellers, who are mostly comprised of small and medium-sized businesses, were a big contributor to Prime Day's success. The Prime Day event was the biggest two-day period ever for these SMBs in our stores. And our 3P revenue continues to grow significantly faster than our online stores revenue. Third-party units represented 56% of our total paid units in Q2, up from a 53% mix 1 year ago. Our second quarter net sales were $113 billion, or at about the midpoint of our guidance range. That's a year-over-year increase of 27%, or 24% excluding the impact of foreign exchange, and included the shift of Prime Day into Q2 this year, which added about 400 basis points to the year-over-year growth rate. Q2 of this year was a transition period for many of our customers. As the quarter progressed, people were at home less as restrictions and lockdowns eased in some of our largest geographies, including the U.S. and much of Europe. As a result, while Prime members continue to spend more with us, growth in Prime member spend moderated compared to spending seen during the peak of the pandemic. As you look at our recent revenue growth rates, I want to give you some insight into what we are seeing, as there have been some noticeable intra-quarter changes in our revenue run rate. Prime Day has also been in 3 different quarters the past 3 years, so I will normalize for this impact in my growth rate comments. Also, since FX rates have bounced around, all of my comments exclude foreign exchange. Here's a quick recap of our growth rates in 2020 and 2021. First, before COVID-19, we've been growing at a revenue growth rate close to 20%. 2019 full year growth was 22%, and revenue growth for the first 2 months of 2020 was 21%. Once the pandemic hit and lockdowns began in March 2020, the initial growth rate jumped into the mid-30% range. Q1 of last year ended with a revenue growth rate of 27%. However, our operations network took time to step up to serve this growth in demand due to space constraints and our need to ramp up hiring quickly while prioritizing employee health and safety. By mid-May of last year, we had made good progress to open up more capacity by adding hundreds of thousands of employees. This allowed our revenue growth rate to jump to the 35 to 45% range, and it remained at that level through Q1 of this year when we had 41% growth. In Q2 of this year, we began to comp this high sales period from last year, and the year-over-year revenue growth rate has narrowed. It has also narrowed as vaccines have become more readily available in many countries and people are getting out of their homes. Since May 15th, again excluding Prime Day, our year-over-year growth rate has dropped into the mid-teens. Our Q3 revenue guidance range of 10 to 16% growth reflects an expected continuation of this trend. Given all this volatility, it is useful to consider the 2-year compounded annual growth rate, which remains strong in the 25 to 30% range. Recall this compares to our pre-pandemic growth rate of 21%. This reflects the acceleration of Prime membership and Prime member purchase levels over the past 18 months. While I'm not giving forward guidance beyond Q3 of this year, we do expect this pattern of difficult year-over-year revenue comps to continue for the next few quarters. As we move forward and start to comp COVID's impact on our revenue growth, we encourage you to also look at the multi-year compounded annual growth rate since the onset of the pandemic to better put this growth in perspective. Now back to the Q2 highlights. We continue to be very pleased with the Prime member growth and engagement we're seeing. We've been fortunate to welcome more than 50 million new members in the past 18 months, and Prime member benefits usage remains high. That includes continued strong engagement in Prime's family of digital offerings, like Prime Video's original movies. For example, Prime members helped make The Tomorrow War and Tom Clancy's Without Remorse the #1 streaming movies on their respective opening weekends. Amazon Advertising is innovating at a fast clip, launching over 40 new features and self-service capabilities in the quarter, making it easier for sellers, companies, and authors to grow their businesses by helping customers discover their brands and products. Other revenue increased 83% year-over-year in Q2, excluding the impact of foreign exchange, driven largely by continued acceleration in our ads business. Moving on to AWS, revenue growth accelerated across a broad range of customers. We see strong growth in enterprises, governments, educational and research institutions, and our startup and digital native customers. We recently announced new commitments and migrations from customers across a diverse set of major industries, including Swisscom and Bell Canada in telecom, BMO Financial Group and Bancolombia in financial services, and Ferrari in automotive. AWS customers recognize that the move to the cloud is very positive for their businesses in the medium and long term. Disruptive economic events like COVID have caused many people to step back and think about how they want to change strategically, and many have come to the conclusion that they do not want to own and run their own data centers. They see that they can save money and gain agility and innovation by moving to AWS. I'll finish up with some comments on our ongoing investments in operations. As we think about the pull forward in demand we've seen these past 18 months, it has required and will continue to require a significant amount of investment in our fulfillment network. Our teams have done a remarkable job stepping up to serve customers and support our vendors and sellers, and we have worked hard to increase capacity at a rapid rate. For the trailing 12 months ended Q2, CapEx and equipment finance leases increased 74% versus the prior trailing 12-month period. And as usual, most of our 2021 spend and building openings are planned in the second half of this year. This is all part of a multi-year investment cycle for us. Unit volumes, while obviously growing at lower rates off last year's large comp, continue to remain high, and we see strong demand for FBA and third-party sellers. So there's more work to do, including additional build-outs of our FCs, as well as our middle mile and last mile capabilities to support our fast improving delivery offers for customers. I encourage you to read the business highlights in our press release. It's a diverse collection of efforts supported by many thousands of customer-focused Amazon employees, from Amazon Pharmacy to Business Prime to AWS's plans to add 7 new regions, to NFL Thursday Night Football starting next year, to the Black Business Accelerator program, to Alexa's collaboration with Ford Motor Company. We remain heads down, focused on driving a better customer experience. We believe putting customers first is the only reliable way to create lasting value for our shareholders. With that, let's move on to Q&A.
Thank you. At this time, we will now open the call up for questions. We ask each caller to please limit yourself to one question. If you would like to ask a question, please press *1 on your keypad. We ask that when you pose your question, you pick up your handsets to provide optimum sound quality. Once again, to initiate a question, please press *, then 1 on your touch-tone telephone at this time. Please hold while we poll for questions. Your first question comes from the line of Doug Anmuth with J.P. Morgan. Please proceed with your question.
Thanks for taking the questions. Brian, I just want to ask two, just going back to the 2Q revenue, beyond Prime spend moderating and the reopening, is there anything else you'd point to in particular that they have kept you in the middle of the range, versus obviously where you've been over the last year versus expectations? And I guess in particular, if you talk about Prime Day relative to your expectations. And then secondly, the BigCommerce partnership a couple weeks ago, you seem to open up more to working with merchants away from Amazon. Just hoping you could talk more about the multi-channel fulfillment opportunity, and do you think you now have the logistics capabilities, and has everything recovered to the point where you can offer these services more to third parties? Thanks.
Sure. Thanks, Doug. As far as Q2 run rate is concerned, if you look back the last few quarters, we've not done a great job of nailing the impact of COVID. We've generally overperformed our guidance range. I think last quarter, we had kept the same process, coming off some very high volumes for the prior 4 quarters. And really the only difference I see in Q2 versus Q1 and before is the year-over-year comp, which we had factored in, but also the increase in mobility. I think the impact of people getting vaccinated and getting out in the world, not only shopping out, offline, but also living life and getting out. It takes away from shopping time. It's good. It's a good phenomenon, and it's great. And we just have to appropriately gauge our run rate going forward. So Prime Day was very successful. We passed the record set in last fall's Prime Day, which was a very different time of year to have Prime Day, and started to bump up against early holiday shopping. So we're really pleased. And again, I think it was a great event for third-party sellers, as I pointed out.
Doug, on your second question, it's Dave here. I'd just say our focus is really squarely on adding capacity to meet the current high customer demand that Brian talked about in his opening remarks. Now, we're always working to develop new and innovative ways to support partners, SMBs in particular, who sell on Amazon. And that includes testing shipping programs and newer initiatives that can help those businesses get packages to customers quickly and reliably. So continue to see us look for ways to be able to innovate where it's appropriate relative to the customer demand we're already seeing in our network.
Your next question comes from the line of Colin Sebastian with Baird. Please proceed with your question.
Thanks very much, guys. I guess sort of masked in the headline results is actually pretty solid performance in higher margin segments of the business, including third-party services, subscriptions, AWS, and advertising. And I think that was evident in gross margin as well. So I guess my question is whether there's any deliberate shift towards these services, or is that just more of an output of the somewhat weaker trends you saw, after mid-May? And then secondly, is Prime Day still a once per year phenomenon, or would you consider separate events, spread out during the same year
to capitalize on different seasonal trends? Thanks.
Sure. On the second question, I don't have anything to announce today. Our trend has been once a year. Of course, it's moved between quarters the last 3 years. So that's all I have on that one. As far as the higher margin areas and whether that's a purposeful strategy, I'd like to say it is, but if you look at what they are, third party is kind of a continuation of strength in our FBA program in particular. I think the sellers are doing a great job of adding additional selection that's very valuable and reinforces our flywheel. And we like to see that, and you see that third-party percent of units went up from 53% last year to 56%. And that's a steady march. We've seen that. As we said, the third-party sellers are doing a great job, and we like to see that. On advertising is, again, another part of our flywheel. We have traffic coming in for the consumer business, and if we do a good job with advertising, we'll make it an additive experience for our customers and our sellers and vendors. So that's what we work on, is to make sure that it's a relevant experience and adds to your shopping experience and helps you find selection that perhaps you wouldn't have found otherwise, or it would have been harder to. And then on AWS is again, its own separate part of the business. It has been 15 years in the development, and we think our scale and experience really pays dividends. If you look at the last quarter, AWS added more revenue quarter over quarter and year over year than any quarter in our history. We're now a $59 billion annualized run rate business, and that's up from $43 billion at this time last year. So those are output measures. As we like to say, the input measures are doing a good job on products, adding new capabilities, and being able to work with our customers to solve their problems. And I think that's what you're seeing, and it's matching up well with a renewed emphasis on getting to the cloud by a lot of companies out there. And when they're looking to make that transition, it's giving up control and putting yourself in and choosing a partner for the long haul. And we're proud that companies choose us for that journey.
Your next question comes from the line of Brian Nowak with Morgan Stanley. Please proceed with your question.
Thanks for taking my questions. I have two, one a little nitpicky, one kind of big picture. The nitpicky one, Brian, fulfillment cost, I guess on a per unit basis, was pretty high in the second quarter, given relative to normal seasonality. Can you just talk to us about what's driving that? Is that a new build, new square feet, or there's sort of inefficiencies that went on in the quarter in fulfillment? And the second one, sort of a bigger picture. In the last quarter, you talked a little bit about same day in Europe. There's been some headlines about same day. How should we think about a larger same day offering being part of the investment process right now, just to sort of maintain and grow your share of grocery and consumables? Thanks.
Sure, thanks. Yeah, I would say on the fulfillment side, there are a number of things. First, we're adding a lot of capacity. If you step back, the Amazon fulfilled unit volume, so that's the units coming out of our fulfillment centers, both retail and FBA, have doubled in the past 2 years. And the AMZL, the delivery arm of our business, has more than doubled in that time period. So you can see there's been very strong multi-year demand here that we are still catching up with from last year. So I mentioned earlier, our year-over-year growth in CapEx and equipment leases is 74% in the at the end of June, compared to 38% the year before. So we're continuing to add, and most of that development is really ahead of us in the second half of the year. So if you've been with us a long time, you know the cadence is that as we add as we add capacity, there's a lot of additional costs, from hiring to starting up to training to getting that building or sort center or delivery station up and running. It usually takes a multi-year period to tame those assets. And we've literally nearly doubled our network here in the last 18 months from a size standpoint. So there's a lot of that going on.
A lot of strong effort by our fulfillment and ops teams to help mitigate the costs. The other thing is wage pressure has become evident. We've talked about this a bit. The wage increase that we normally would do in October, we pulled forward into May. We're spending a lot of money on signing and incentives, and while we have very good staffing levels, it's not without a cost. It's a very competitive labor market out there, and certainly the biggest contributor to inflationary pressures that we're seeing in business.
Brian, on the second point, just around speed, as we've talked about many times, customers respond well to the fast, high-quality delivery. And of course, back in 2019, we were talking at that time about expanding the one-day delivery in the U.S. In Europe, one-day delivery as part of Prime in most of those sizable European countries where we operate has been standard for many years. We're investing in the transportation network to support the demands. A significant part of the capital investments we've been talking about for the past few years, and certainly since the pandemic's start, has been to support those efforts in middle and last mile capacity to keep pace and support with that demand. So as we've been saying here, that work's not done yet. We're continuing to expand. You'll see that investment throughout 2021. And that growing transportation network will support faster delivery times for customers. One-day delivery is improving, and in the U.S. As well as same-day delivery, where it makes sense and where the network is growing there. So we'll have to continue to see how we go, but we're focused on those data points, and we're also focused on improving delivery precision as a way of improving the quality of the overall offering.
Your next question comes from the line of Youssef Squali with Truist Securities. Please proceed with your question.
Thank you very much. I have two questions. One, within online stores, was there any particular area of softness during the quarter? I'm just thinking about maybe some product categories that may have come back, or actually the opposite, may have gone down the demand for with the reopening that you can maybe highlight. And then as you look beyond Q3 and Q4, what kind of growth assumptions for e-commerce just in general for the next couple of years are you guys working with to build your budget and invest against the opportunity? I'm just thinking, are you guys assuming that e-commerce growth remains or goes back to pre-COVID levels or stays kind of at an elevated level versus that? Thank you.
Sure. Let me start with the online stores revenue. You're probably looking at the growth rate of 13% in Q2 versus the revenue growth, FX neutral revenue growth rate of 24%. I would point you back to last year in Q2. That online stores grew 49%. There were restrictions on what we stocked in our warehouses, and you remember we had to constrain space for a lot of third-party sellers as well as our retail offering. But the mix shifted for the early part of Q2 last year to be more of a retail mix and an MFN mix, and then it flipped back to be more of a balanced mix that you'd seen in the past. On forward investment, here's how I'd explain it. We are sitting here with demand volumes that have gone up on an Amazon Fulfilled Network basis. They've doubled in a 2-year period. So we are not back to where we want to be on a number of dimensions. We handled Q4 last year. We've been playing catch up pretty much since the pandemic started. But what suffered is space and space constraints, and that's it's gotten better, but it was a factor last year. And also our one-day delivery percentage has dropped and has not returned to levels seen pre-pandemic in the United States. It's on par and getting better than pre-pandemic in Europe. But in the United States, while it's improving, it still hasn't reached the pre-pandemic levels. So we have a lot of growth to do there. As far as the stickiness of purchases, I think there's certainly a number of things that were purchased last year that didn't repeat for a lot of retailers, things like consumables early on, gloves, cleaning supplies. computer monitors, things you use to outfit your house. You probably go through your own checklist of purchases and say, okay, I probably will not do this every year. But there has been a healthy movement to online commerce. We've added Prime members, and the Prime members that we have ratcheted up their purchases with us, which is always a part of the plan and a good sign. It means we're offering them more things that they can buy and satisfying more of their demand needs. So even in Q2, when, as I said, rates are starting to moderate, in the quarter, those Prime member purchases still grew year over year on the per Prime member basis. They just didn't grow at the same clip that they had in the prior 3 or 4 quarters. So that's a good sign. And we like the engagement levels and the retention levels that we see with Prime members. So all in all, a very positive story on that front. Has accelerated the model quite a bit. There's just, again, some comparison issues that we'll just have to realize and perhaps look at a 2-year compounded annual growth rate for a period of time to judge where we are on that progress, because there's been a lot of ins and outs, especially with Prime Day moving around. So hopefully that answers your question.
Your next question comes from the line of Stephen Ju with Credit Suisse. Please proceed with your question.
Thank you so much. So, Brian, it seems like the pandemic has touched off what looks like a greater urgency among SMBs to accelerate their presence online. So, I was wondering if your third-party marketplaces platform is seeing perhaps a faster influx of more sellers or emerging brands. And, following up on the labor market commentary there, do you think you will see any incremental headwinds, hiring the necessary people for fulfillment centers this year? Thanks.
Stephen, it's Dave. I'll take that first question just around SMBs and behavior. I think, look, we've seen a 20-year progression in terms of building out the services that we thought were resonated with us and our business, but also sought very early on to externalize those services and offerings to sellers, and particularly small and medium-sized businesses over time. Obviously noteworthy with FBA and many other features. And so I think this, what you see is really just a continuation of that effort put out by the teams around whether it's logistics, brand representation, more recently in recent years with some of the advertising features we've been able to develop, surface for all our selling partners. And so I think that's a big area and a big part of commitment. So I don't know that I'd call it anything specifically in the near term other than to say that we continue to see great momentum on a units basis. As we give that metric every quarter, about 56% of our overall total paid units are third party. That's up about 300 basis points year over year. So expect for us to continue to put forth that effort in FBA around the world for sellers and some of these other SMB features continue to gain momentum there.
And on the labor comment, we can't predict too far in the future. We've got labor estimate in our Q3 guidance. I would say it's a bit of a complicated mix of economic growth and industries opening up, government payments in some areas that may impact people's working, and then whether or not children are back at school fully in the fall. So there's a lot of dynamics. We do count on having more employees in Q3 and Q4, as you know, from our ramp up to the holidays. So I would probably count on wage pressure remaining for the immediate future.
Our next question comes from the line of Ron Josey with JMP. Please proceed with your question.
Great, thanks for taking the question. I wanted to ask on just international operating income. It's, if you look at the results, it's now producing consistently positive results here. And so can you talk to us a little bit more, just talk to us about what's driving that? Is this the result of most major builds are now complete and you're seeing the efficiencies in fulfillment centers, and so we should see this trend continue, or is there something else that's driving international operating income just remaining positive here? Thank you.
Sure, Ron, thanks for your question. Yes, we have had strong international results in the last 5 quarters or so, noticeably they've been positive operating income, which had not been the trend prior to Q2 of last year. I would say the major factors here are the acceleration of growth. So we've, in some ways, put the set 2 years out growth on top of today's assets. That's a lot of stress, but it's a lot of leverage of the assets that we have. And as we've talked about before, our fulfillment centers and operations have been running pretty much at peak since May of last year. It's starting to mitigate a bit, but it's a strong undercurrent. But having said that, we continue to invest in international expansion. You may have noticed that we added Portugal as a prime country last quarter. We have investments in Brazil and India and the Middle East and a number of countries. So we continue to add new countries. We're having strong performance in our more established countries like Europe and Japan. And so it's a bit of a mixed bag, but right now, again, the performance is very strong. The foreign exchange rate has been favorable as well the last few quarters, so that has helped. But really pleased with the performance of our international teams. And we'll see, again, our investment plans, our plans are to make money, obviously, in the long run, but we have forward advanced Prime benefits in a lot of these countries before they would have been able to see them if they have run the same trajectory as we did in the U.S. So there's a bit of forward investment on Prime benefits, especially things like video that we know resonate with customers and are good for the Prime program and turn into eventually really strong businesses.
Our next question comes from Jason Helfstein with Oppenheimer. Please proceed with your question.
Thanks. So maybe one on Amazon, then a follow-up. So AWS. So you saw 10% sequential growth in the quarter. You saw that also in the fourth quarter. Was there anything around reopening that made second quarter AWS exceptionally strong and that we should kind of keep in mind going forward, or we feel like this was kind of a normal quarter for kind of AWS and this is a kind of a good cadence for the business? And then just a follow-up, just your point about the ability to kind of keep up. Is there any kind of throttling of FBA that's going on just because you don't have the capacity, or you're trying to say that you might be losing share to other sellers who can kind of promise to get an item to customers faster, given still some of the challenges with logistics and last mile and everything? Thanks.
Yeah, hi, Jason. Thank you. Let me start with that second question. No, my comments were really about throttling of space last year, which did impacted our vendors and our retail business as well as our third-party business. It's probably more pronounced in Q2 of last year, especially April and into early May, as we were working to get fully staffed in a helpful and safe way and also build out more capacity. In Q4, again, we were handling volumes that were somewhat unheard of, year over year. Our Q4 growth rate was 42%. That's usually not the case, and it's magnified at peak when we're already handling the highest volumes of the year. So all I was trying to say was that our space planning and, if you will, throttling of space for third-party sellers is not something we like to do. We don't think we're the only ones who had that issue, and that's why we're building out our network so quickly in our minds. It's hard to do quickly, but we're moving as quickly as possible. And again, we have a lot of new capacity being added in the second half of the year. On AWS growth, if you look at the run rate, last year we had 33% growth rate in Q1, and it dropped to 29, 29, and 28 the last 3 quarters. There's always a lot of year-over-year things going on, but we do note that last year there was a lot of effort by companies to limit their spend and operate more efficiently as we're all plunged into kind of an unknown demand curve, and some industries were hurt worse than others. If you'll remember, we actually worked very hard with our customers to help them lower their demand for AWS services as best we could to match any new demand patterns. We also helped people scale very quickly. Companies like Disney Plus, Netflix, and others were very glad that AWS was there to help them scale to meet volume very quickly. So there's a lot of mixed bag there. We think that it was a strong performance this quarter. We do see good trends with new contracts and new clients that are either signing up with AWS and making the journey to the cloud, or accelerating their journey to the cloud, or setting up new longer-term contracts with us.
Our final question will come from Justin Post with Bank of America. Please proceed with your question.
Great, a couple. No one's really mentioned the CEO change, so I was wondering if, he's not on the call, but any change in direction, investment philosophies, or any more integration of AWS, or anything that we should be aware of related to that change? And then second, AWS margins, really strong revenues. The margins came down quarter over quarter. Can you just remind us of what drives some of that margin fluctuation? Thank you.
Sure. Let me start with the second one. So, again, at any point in time, there's a lot of cross pressures in the operating margins of AWS. There's growth, which helps us leverage our assets. There's increasing the efficiency of our servers and the efficiency of our sales force. Those are all positives. On the flip side, there's price decreases. There's new contracts signed with large players for multiple years, so there's pricing pressure. There's also the expansion of the sales force and building infrastructure to add new regions globally. So, as we said, these margins are going to bounce around. We're happy with the Q2 margins. I would note that there was a negative impact from foreign exchange that was about 150 basis points. But even at 28.3, it's a strong margin for this business. We know it's going to bounce around as we invest, but also work very hard to scale our businesses and efficiently run our assets. On the leadership change, as you expect, Andy has hit the ground running. He's continuing to have a very high bar for customer experience, high standards, operational excellence, inventiveness, willingness to fail, and everything else that Amazon is known for internally and externally. I think we've had a good handoff. Jeff, of course, is moving into executive chairman role, and he will not be leaving. He's obviously continuing to be very involved in, as we say, the one-way door decisions. We've also had a good leadership change at AWS with Adam Selipsky coming in. Adam himself comes with a lot of Amazon history and knowledge and external CEO experience that has made him even stronger as he comes back. So we feel really good about the transition, and of course, don't expect any drop, and expect Andy to add his unique brand of positive attitude and optimism and forward-looking focus to help Amazon keep going and delighting customers.
Thanks for joining us today on the call and for your questions. A replay will be available on our IR website for at least 3 months. We appreciate your interest in Amazon, and we look forward to talking with you again next quarter.